What's up, everyone? It's Brandon. Do you own a stock that recently cut its dividend or has underperformed for months or years? Perhaps you're wondering when to sell dividend stocks to avoid potential losses in the future. While this situation can be frustrating as a dividend investor, it doesn't necessarily mean that your portfolio is in trouble. In this video, I share 8 warning signs to help you understand what to look for before making any decisions about the future of your portfolio. The first warning sign that you should understand is when the dividend is either cut or suspended. Companies will cut, or worse, suspend their dividend from time to time to invest more profits back into the company. While this is often a good thing for the company itself, it can leave dividend investors low on income. If the company has recently cut its dividend, you will need to examine the core reasons for the reduction. Is the cut temporary because the market declined or a recession? Is the amount of the dividend reduction more than 50%? Several of the world's largest banks dramatically cut their dividends during the 2007-2008 financial crisis, but quickly recovered in the following years. These companies intended to continue paying dividends, but needed to scale back the amount paid to shareholders to make ends meet during the crisis. It's better not to sell stocks that cut dividends in this situation. However, if a company suspends its dividend program, you won't be able to reinvest the dividends for passive income. Therefore, it's best to sell all shares of the company and repurchase shares of companies that can provide consistent dividend payments. The second reason you might want to sell a dividend stock is when there are fundamental changes in the business. If you invest in a company that has recently changed its business model, products, or services, it might be time to move on. It's essential to invest in companies you understand and provide services you can stand behind. When a company changes its core fundamentals, it risks losing customers and revenue. Imagine if Apple suddenly stopped selling iPhones and focused more on their Apple TV Plus products. The iPhone is a revolutionary product that transformed the mobile phone industry, and Apple wouldn't be the same without it. It's no surprise that dividends are paid based on cash flow and performance from quarter to quarter. However, if you no longer believe in a company after fundamental changes in the business, it's time to sell your shares and invest elsewhere. The third reason is when the payout ratio is too high. If you're a beginner learning how to invest in the stock market, you might not know about the payout ratio. In short, it's a financial indicator representing the percentage of profits a company pays to shareholders as a dividend compared to total earnings. For example, if a company earns $4 per share and pays a dividend of $2 per share, the payout ratio would be 50%. In this case, the company would pay shareholders half of its profits and invest the other 50% back into the company. Suppose a stock has an excessively high payout ratio. The company is probably not reinvesting enough earnings, increasing the risk of lower growth and future earnings potential. There are some legal exceptions, such as specific energy and real estate stocks. However, it's usually best for investors to sell dividend stocks with abnormally high payout ratios. There is no ideal payout ratio. Furthermore, a general rule is to invest in dividend stocks with payout ratios between 0 and 50%. The fourth warning sign to sell a dividend stock is when the company's earnings decline over time. It's not reasonable to expect that all stocks in your dividend portfolio will perform successfully long term. Times change, and the needs of consumers and businesses also change. There will always be companies that will struggle to keep up with market demands and competitive expectations. As an investor, you must be willing to remove underperforming stocks from your portfolio if your cash isn't growing due to a company's performance. Healthy companies will produce positive revenue growth, and in turn, success will reflect in the earnings. If a company in your portfolio is no longer profitable, it's best to sell the stock and move your cash into assets with higher earnings potential. Warning sign number 5 is when the company's debt is unreasonable. A company can't operate long-term if it pays out more in dividends than it earns. Any business needs to manage its balance sheet effectively to grow and be profitable. When a company uses debt unreasonably to supplement its cash flow, it also places the dividend at risk of being cut or suspended. Over-leveraging debt to cover the dividend program is not beneficial for dividend investors. However, some companies like ExxonMobil utilize debt efficiently and still have excellent credit ratings. This argument doesn't mean that ExxonMobil is a safe dividend stock and that you shouldn't sell it. It suggests that companies with higher debt loads aren't always an automatic warning sign to sell dividend stocks. The problem arises when companies over-leverage their debt instead of using free cash flow as the primary source for dividend payments. If a company in your portfolio uses too much debt to cover its dividend, it's best to sell the company and search for a suitable replacement. Warning sign number 6 is when the dividend yield is too high. There are times when a stock's dividend yield becomes unreasonably high. For example, you purchased a stock years ago with a 3% dividend yield, and today the share price is much lower and has a new dividend yield of 13%. A dividend yield of 13% is just too high and it's not safe. If you were to purchase the same dividend stock today, you would receive $13 for every $100 invested. The higher the dividend yield, the more cash a company pays its shareholders per share. The return sounds nice, but creates a problem where the company returns too much money to shareholders. Because of this, the company might not be reinvesting enough of its profits back into the business model to fuel growth. It might be tempting to purchase dividend stocks with the highest dividend yields, but this is a dangerous trap that you should avoid. Excessively high dividend yields are bright red flags. It's better to buy companies with a history of growing their dividend over time. If an investment in your portfolio yields higher than 6%, its dividend could be at risk of being cut or suspended. In this case, it's probably time to consider selling. The seventh reason to sell your dividend stock is when the dividend growth rate is too low. The compound annual growth rate of a stock tells us how much the dividend payout has increased on average in previous years. For example, Johnson & Johnson has a 5-year growth rate of 5.79%. Except for the last 18 months, this compound annual growth rate has outpaced inflation and provides solid income growth for dividend investors. Dividend increases are an essential part of the dividend growth investing process. If a company can't increase its dividend enough to keep up with inflation, the investor's long-term income will suffer. It's best to invest in stocks that have dividend growth rates over the rate of inflation. Under normal economic conditions, this value is around 2% annually. However, the current inflation rate is 8.3%, and because of this, selling based on the growth rate is a little bit unreasonable, at least in the short term. The last reason is not a warning sign for when to sell dividend stocks, but more of a bonus reason, and that is when you want to rebalance your portfolio. It's common for investors to rebalance their portfolios once a year. Portfolio rebalancing is a strategy that helps investors to moderate the risk tolerance by controlling the amount of equity in each asset class. When rebalancing for diversification, you typically sell a portion of the investments that are performing well, then use the profits to purchase underbalanced assets. For dividend portfolios, overperforming dividend stocks are sold and then reinvested elsewhere. You may have already sold dividend stocks for this reason. Rebalancing your dividend growth portfolio can also help you become more profitable over time if done correctly. Knowing when to sell dividend stocks can be challenging for beginner investors. However, using this guide can help you understand what to look for before making any decisions about the future of your portfolio. Selling a beloved investment can be scary, but you'll have the confidence to make the right decision once you comprehend these 8 warning signs. Well, that's it for now. Don't forget to like the video and subscribe to the channel for more dividend growth investing and personal finance videos. Thanks again for watching, and I'll see you next time.